They told us it was impossible. They told us the system was too diversified, too sophisticated, too protected to fail in a single moment. They told us that modern finance had learned its lessons, that risk was sliced, packaged, insured, and scattered so widely that no one collapse could ever bring everything down. And then, on a quiet September morning, one name shattered that illusion: Lehman Brothers. A firm older than the telephone, older than the light bulb, older than most modern nations. A firm that survived wars, depressions, and financial panics. A firm that collapsed in a single weekend and, in doing so, pulled the world economy into one of the deepest crises in history. The mystery is not just how Lehman Brothers failed. The mystery is why its failure mattered so much. Why one bankruptcy turned into a global chain reaction that froze credit, erased trillions in wealth, and reshaped the financial world forever. To understand that, we have to go back long before the collapse, to a time when Lehman Brothers was not a symbol of excess, but a symbol of ambition. The firm began in the mid-19th century as a humble dry goods store in Alabama, founded by German immigrant brothers who extended credit to cotton farmers. That early insight, lending against future production, would echo through the firm's DNA for more than a century. Over time, Lehman evolved from cotton trading into investment banking, financing railroads, underwriting corporations, and helping to build the American industrial economy. By the late 20th century, Lehman Brothers stood among Wall Street's elite, a powerhouse known for aggressive trading, sharp minds, and a deep belief in its own resilience. Inside the firm, there was a sense that Lehman did not just survive history, it mastered it. But the world around Lehman was changing. In the decades leading up to the crisis, finance underwent a quiet revolution. Traditional banking, built on deposits and loans, gave way to a system driven by capital markets, securitization, and leverage. Mortgages were no longer held by local banks until maturity. They were bundled, sliced into tranches, and sold to investors around the globe. This process was sold as innovation. Risk, we were told, was being spread, diluted, and managed. Mathematical models promised precision. Credit rating agencies stamped complex securities with the highest ratings. Regulators, convinced that markets were self-correcting, stepped back. And in this environment, leverage became the accelerant. Lehman Brothers embraced this new world with enthusiasm. It did not have a large base of customer deposits like traditional banks, so it relied heavily on short-term borrowing to fund long-term investments. This worked beautifully when markets were calm. Cheap borrowing allowed Lehman to amplify returns. Profits soared. Executives were rewarded. The firm's balance sheet grew rapidly, packed with mortgage-backed securities and real estate investments that seemed safe, diversified, and endlessly liquid. Internally, confidence hardened into certainty. Models showed low risk. History, at least the recent version, showed rising housing prices. And the assumption underlying everything was simple and dangerous. Markets would always provide an exit. At the center of this story were not villains twirling mustaches, but highly intelligent professionals operating within a flawed system. Traders chased yield because incentives demanded it. Executives pushed for growth because competitors were doing the same. Investors rewarded risk-taking with capital and praise. Each individual decision made sense in isolation. Together, they built a structure that depended on perpetual confidence. And confidence, as history shows, is fragile. The first cracks appeared quietly. Housing prices, which had risen steadily for years, began to stall. Subprime borrowers started missing payments. At first, the damage seemed contained. These were, after all, lower-quality loans. The belief was that higher-rated tranches were insulated, but the system was far more interconnected than anyone wanted to admit. As defaults increased, the value of mortgage-backed securities became harder to determine. Trading slowed, prices became uncertain. And in a system dependent on short-term funding, uncertainty is poison. Lehman Brothers was particularly exposed. Its balance sheet was massive relative to its capital, and a large portion of its assets were tied to real estate. Worse, many of these assets were difficult to sell quickly without taking large losses. Still, Lehman's leadership publicly projected confidence. They raised capital. They reassured investors. They insisted that liquidity was strong and risk was manageable. Internally, however, the pressure was mounting. Counterparties began to ask harder questions. Lenders demanded more collateral. The cost of borrowing rose. Here is where cause and effect tightened into a vice. Lehman relied on the repurchase agreement market, a form of overnight borrowing where securities are pledged as collateral. As doubts about Lehman's assets grew, lenders pulled back. Each withdrawal forced Lehman to sell assets or post more collateral, which further weakened its position. This, in turn, fueled more doubt. It was a classic run, not by depositors lining up outside branches, but by institutions clicking buttons and refusing to roll over funding. Throughout the summer before the collapse, rumors swirled. The fate of Bear Stearns, another investment bank that had been rescued earlier that year, loomed large. Many assumed that Lehman, if it reached the brink, would also be saved. After all, it was deeply interconnected. Its failure would hurt everyone. That assumption would prove fatal. As losses mounted, Lehman searched desperately for a buyer. Talks with potential acquirers dragged on. Regulators hovered, uncertain and divided. Some argued that saving Lehman would reinforce moral hazard, teaching markets that risk would always be backstopped. Others warned that letting it fail would unleash chaos. The decision point arrived on a September weekend, behind closed doors, as markets around the world waited. When no rescue came, the illusion shattered. Lehman Brothers filed for bankruptcy, the largest in history at that time. The immediate reaction was shock, but the deeper impact unfolded over days and weeks. Financial institutions around the world suddenly questioned every counterparty. If Lehman could fail, anyone could. Credit markets froze. Banks stopped lending, not because they lacked money, but because they lacked trust. Money market funds, once seen as safe as cash, faced runs. Companies with healthy businesses found themselves unable to finance daily operations. Global trade slowed. The chain reaction was relentless. The effects rippled far beyond Wall Street. Retirement accounts plunged in value. Housing markets collapsed further. Unemployment surged. Governments scrambled to respond, injecting liquidity, guaranteeing debts, and in some cases, nationalizing banks. What had begun as a problem in a corner of the mortgage market had metastasized into a full-blown global financial crisis. And at the center of the narrative stood Lehman Brothers, not as the sole cause, but as the trigger that revealed the system's hidden fragility. In the aftermath, investigations searched for a single moment or decision that doomed the firm. Some pointed to accounting maneuvers that temporarily reduced reported leverage. Others blamed regulators for failing to intervene sooner. Still others argued that the real failure was ideological, a belief that markets could police themselves without strong oversight. The truth is more unsettling. Lehman did not collapse because of one bad bet or one dishonest act. It collapsed because an entire system rewarded short-term gains, underestimated tail risks, and assumed liquidity would always be there when needed. The attempted fixes that followed were massive, but imperfect. Capital requirements were raised. Stress tests were introduced. New rules aimed to limit risky trading and improve transparency. Yet, even as these reforms took shape, financial markets adapted. Risk migrated. Complexity returned in new forms. The fundamental tension between innovation and stability remained unresolved. What makes the Lehman story especially relevant today is how familiar the patterns feel. High leverage, justified by sophisticated models. Assets assumed to be liquid until they are not. Confidence built on recent history rather than long-term perspective. Shocks dismissed as contained until they are not. Whether in housing, technology, or new financial instruments, the cycle repeats with unsettling consistency. Modern markets move faster than ever. Information spreads instantly. Capital can flee in seconds. That means chain reactions can unfold with even greater speed and force. The lesson of Lehman is not that finance is inherently dangerous, but that systems built on trust must account for how quickly trust can vanish. Stability is not the absence of failure, but the ability to absorb it without collapse. As we reflect on the fall of Lehman Brothers, 3 takeaways stand out. First, leverage magnifies everything, including mistakes. It creates the illusion of strength in good times and guarantees vulnerability in bad ones. Second, interconnectedness is a double-edged sword. It spreads risk, but it also spreads panic. When links are opaque, fear fills the gaps. Third, assumptions matter more than forecasts. The belief that markets will always function smoothly is not a strategy. It is a gamble. The warning is clear and uncomfortable. The next crisis will not look exactly like the last one. It never does. But it will rhyme. It will emerge from places we are currently celebrating, from innovations we are currently praising, from risks we are currently explaining away. The question is not whether another chain reaction will occur, but whether we will recognize the warning signs before confidence turns into complacency. If you want to understand the forces shaping our economic future, the rise and fall of Lehman Brothers is not just history, it is a lens. And if you found this story valuable, take a moment to support the channel, share it with someone who thinks markets are always rational, and subscribe for more deep dives into the moments that quietly change the world.